Bond ETFs are an increasingly popular part of the market as managers look for precision tools to move around their portfolios. I'm Chris Dietrich, writer and editor of funds at Barron's. I'm here with Bob Smith, Chief Investment Officer at Sage Advisory in Austin, Texas. Bob, people have been talking about what the Federal Reserve is going to do for a really, really long time. Talk to me about your view about that and how you've been moving around your ETF bond portfolio.
Good day, Chris. Thank you. We believe that the Fed is in a hold position at the moment. We don't believe that we are going to see any major shift in policy towards the end of this year, and certainly probably well into the first half of next year. What's that done for our portfolios? Basically, we were very cautious going into the beginning of 2015. Our maturities were a little bit shorter than the market, and while we felt that we wanted to be very well diversified, we felt valuations got very high for corporate bonds, for high yield bonds and so forth. So we brought those back and we reduced those. And as we got into the middle of the year, we felt that we wanted to be a little bit more defensive with regard to interest rates and yield spreads between the sectors. That didn't turn out to be the case. The market corrected over the summer. And as we got into the back end of the summer, we thought the market got very pessimistic, in fact, overly pessimistic relative to the underlying fundamentals.
Did that present a bit of an opportunity for you to step in?
Absolutely. We felt that the baby was indeed thrown out with the bathwater, and that we moved back into the high yield market for our core plus fixed income strategy.
And highlight for us which specific ETF you like for high yield.
For us, we tend to buy the more passively oriented, index-oriented ETFs. So HYG, which is the largest in the marketplace, has the highest trading volume, the largest amount of securities, the greatest diversification. We felt that was an appropriate measure. We also went into preferred stock and convertible bonds as well.
That's great. So a time for a little bit more risk at this point. You know, there's nearly 300 bond ETFs on the market. Maybe highlight just 1, 2, or 3 things that all investors should look at before they dive into a bond ETF.
Sure. I think the rules of the road are really important. First thing is understand the index that underlies your ETF. Understand its composition, how it's put together, what its risk-reward characteristics are, not only right now, but what they've been historically. Because if you don't understand that, you shouldn't be buying a security that's based on that. The second thing is the size and scale of the provider. We generally prefer to be working with and operating with ETFs that are brought to market by very large providers who have deep resources and very large scale to provide information, to provide help in market making and research. And then the third part is really understanding the security itself. It's not just about the lowest expense ratio, but it's the expenses that I'm paying in the expense ratio, as well as the tracking error, the percentage of replication in my ETF of the underlying index, the volume of how much does this trade on a day-to-day basis, not only in terms of, frequency, but how many participants, what types of investors are involved, and then lastly, the size of the ETF.
So absolutely take care to look under the hood and make sure it's trading enough.
Yes, Chris, without a doubt.
Excellent. Well, thanks so much for joining us, Bob. This is Chris at Barron's signing off.